now?
So I really like it. I know that there.
Joining us, the president and CEO at Main Street Asset Management. Good morning, Aaron. Tell me how you feel about this group right now.
So I really like it. I know that there are, a few names, particularly Salesforce, that are really struggling, that have gotten hit, particularly since the first major downturn that we saw around Thanksgiving, and they're getting hit a little further. But these companies, and I specifically am looking for software services that are more focused on businesses. So they're selling to businesses versus the consumer. And I think that's where you have, your higher margins, better inflation protection. They're better able to pass on higher prices and keep those very high margins and keep their growth. And as we look at the prices coming down, it's really been about valuation compression. They were trading at extremely high valuations. There's no question about that. But now when you're looking at them, they're coming more towards their 3-year average, their 5-year average valuations, and really starting to look more reasonably priced. So I own ServiceNow and OW. I actually added to my position when it got hit around Thanksgiving. It's also it went back up and then is now back sort of at that hold of around $600. I think this is a great entry point if you're looking for a phenomenal company that really, consistently beats top and bottom lines, has exceptional growth, and 80% margins. So I think it well deserves its forward valuation of 90 times. CRM, Salesforce, much more well known than ServiceNow, but again, this business type of software and cloud services, for me, I would really be willing to get in even further if when it gets around 225. It's already below its 3-year average valuation while still keeping up its growth rate. So I think when we go through these very quick periods of fear, and when those growth stocks are getting hit a little harder, and they have been both in the sort of the Thanksgiving downturn and this Christmas downturn, particularly around more COVID fears than really worrying that we're not seeing that their earnings expectations are becoming lower. It's more just general market fears. We're seeing selling out of your most expensive equities and moving into more fixed income as bond prices keep getting pushed up further. But I see this as much more of a short-term trend. We saw this last year. It happened for about 3 months when the Delta variant first came out and inflation fears first or really reared their head. Yep. The equity markets traded sideways for about 3 months. And so being able to buy on those lows, buy on the dips, wait it out 2 to 3 months as the economy sort of reassesses where they're going to grow, what the economic growth is going to be, and resumes its upward trend, which I do expect it to do in 2022. I think these are the opportunities to really look at some very high quality names at much more reasonable prices.
Okay. Now, those more reasonable prices, Aaron, nothing, I think, summarizes the discussion over software better than describing ServiceNow as a deal when it drops down to 90 times forward earnings. I mean, obviously, you're leaning into that fact as looking at a company where investors have paid up for growth at any price. Does that change if the Fed's for real and they're actually going to hike next year? Do people stop paying 90 times for these companies?
Even with inflation and even if the Fed raises rates, remember, we're coming off of exceptional lows. So people will still be willing to pay certainly 90 times. And in fact, their 5-year average, just 5 years ago when the Fed was at higher rates, their forward valuation was 82 times. So that's what I'm saying. They're really not that far ahead of where they were when we were just looking at slightly higher rates, right? Even if we get 1 or 2 hikes. Or if the 10-year is trading at or is getting a 3% yield versus 1.5. So these are the things we look at historically. This company has always traded at very high valuations because they do have exceptional growth. They do make 80% gross margins and consistently. That type of high quality and high growth will always be able to and achieve a higher premium. But now that we're coming back down to more what they've been trading at historically, I think that's an opportunity.
Okay, Aaron, thanks for the setup here. We're going to trade bullish on these. ServiceNow and Salesforce. Aaron Gibbs joining us from Main Street Asset Management.